By 2026, the annual capital expenditure for AI infrastructure is projected to reach $527 billion. This represents a global sprint to construct the physical foundation required for large-scale machine learning. This initial phase targets the picks and shovels of the industry, the specialized compute, high-density storage, and networking capabilities that traditional data centers simply weren't built to provide. Hyperscalers are driving this physical transition. Google Cloud recently reached a $54 billion annual revenue run rate, fueled largely by enterprise demand for specialized tensor processing units and GPU clusters. Yet there is a disconnect between this massive corporate spend and the wider market. While companies are investing billions in hardware, most individual consumers are still only interacting with free versions of the technology. This creates a central tension for investors. They must decide if this surge in capital expenditure will yield a proportional return, or if the current spending is scaling far beyond the near-term revenue these models can actually generate. This uncertainty has triggered profound financial skepticism among institutional analysts, who are questioning the true return on investment for the current AI boom. Total global investment in AI infrastructure is currently estimated to reach between $7 and $8 trillion over the coming years. The market is reacting. As hyperscalers increase capital spending, the hit to free cash flow causes major stocks to underperform. Infrastructure providers are vulnerable. If operating earnings face pressure while multi-billion-dollar buildouts are debt-funded, the financial math becomes difficult to justify. Goldman Sachs' analysis suggests that even if you sum up every addressable profit pool, from digital advertising to customer service, the resulting opportunity still falls short of covering a $7 trillion infrastructure bill. If the hardware alone cannot provide a path to profitability, it suggests the real wealth transfer isn't happening at the infrastructure layer, but in how the technology is actually being used. To find that value, we have to look past the companies building the chips and toward the enterprise buyers who are integrating AI to multiply their output. By expanding technical automation to work activities that previously required human natural language understanding, these tools shift the productivity baseline for 850 occupations. If those saved labor hours are redeployed effectively, global productivity could see an additional growth of 0.6% annually through 2040. We are already seeing this reflected in company balance sheets. Industries with the highest exposure to AI are currently achieving 3 times higher growth in revenue per employee. Furthermore, those with specialized AI skills are now commanding a 56% wage premium. AI's true economic contribution isn't found in simple cost-cutting, but in creating revenue multipliers that allow an organization to generate significantly more value with the same headcount. The mechanism driving this leap is the transition to what is known as agentic AI. While early AI simply responded to prompts, agentic systems are autonomous. They can reason, plan complex tasks, and execute them without constant human intervention. This shift has massive institutional backing. Amazon AWS recently committed an additional $100 million, specifically to help businesses transition from experimentation to these fully autonomous systems. This autonomy allows companies to automate highly complex processes. For example, some firms now use AI agents to analyze system logs and infrastructure changes in real time, identifying the root cause of network disruptions in minutes rather than hours. The shift from a tool that answers to an agent that acts is what separates speculative hype from companies generating actual profit. The current surge in infrastructure spending follows a pattern strikingly similar to the 1990s telecom boom. In that cycle, massive investments were made in foundational hardware before the most profitable applications existed. Historically, the infrastructure layer faces a boom and bust cycle, while the companies that eventually use that hardware to build new services capture the long-term wealth. Investors are beginning to differentiate between these players. The stock price correlation between the major hyperscalers has dropped from 80% to just 20% as the market searches for the actual winners. Portfolios are rotating toward companies that can demonstrate a clear, verified link between their capital spending and actual revenue benefits. Buying the companies that build the infrastructure is no longer a safe bet. The market is now demanding real-world financial performance. Much of this performance is coming from AI-native companies, startups built from the ground up with artificial intelligence as their core technology stack. These organizations avoid the retrofit problem. While legacy giants struggle to integrate AI into old systems, these startups achieve extraordinary productivity leaps by designing their entire workflow around it. The long-term goal for this technology is not just efficiency, but the creation of entirely new economic activity and addressable markets that we cannot yet imagine. Point 7 of this report notes that despite the current momentum, the transition to enterprise-wide financial impact remains ahead. Realizing the multi-trillion-dollar potential requires the long-term redesign of core business processes. The greatest wealth transfer of this decade will likely bypass the infrastructure builders. Instead, it will flow to the agile enterprises that use this hardware to build the next generation of the global economy.